Hello friends, last week in my video, I gave you a 10-point checklist for these factors to watch out for. And most of them were kind of cautionary in their nature. And I also shared a lot of media articles and what was basically weighing on the minds of the average rank and file trader. Now, the biggest events that we were waiting for, that is the US presidential elections and the US Federal Reserve's interest rate meeting, are done and dusted. Now, just when you thought that my prognosis of the market was going wrong because the markets really shot up on Wednesday, what happened on the following day, Thursday, was that the bulls actually managed to snatch defeat out of the jaws of victory. Yeah, you heard that right. There's no grammatical mistake in what I'm saying. They actually managed to surrender all that they had gained in the previous day, that is on Wednesday, and then some more on Friday. So we are back on track, and there is a slight amount of nervousness in the market. And in this video, I want to talk to you about what to anticipate in the week ahead. I remember I promised you that I would make a video on what to expect out of the Trump presidency. Remain assured that video is in the pipeline. It's being worked on as you watch my video here, and it'll be released pretty soon. For now, let's dive into the weekly market roundup window on your screen. And as you can see, the fall was basically across both the indices, with the broader based Nifty 50 actually managed to fall more than the sectoral bank Nifty. And the US dollar index, the Dixie, continued to rally higher because the market expected that a Trump presidency would basically see revival in the fortunes of the US economy. Now, a strong dollar basically exerted downward pressure on gold and silver, and as a matter of fact, even crude oil and natural gas. I have been telling you that gold and silver are likely to go down in a video. The hyperlinks to all the videos that I want you to see are in the description below this video, as well as in the pinned comment below this video. So commodities were down because of a very strong dollar. The USD INR, that is the United States dollar versus the Indian rupee, also rallied sharply, and the rupee was basically at a new low versus the United States dollar. The Indian 10-year benchmark bond yield fell 6 basis points. That means bond prices actually rose a little, and that is what cushioned the bank Nifty somewhat. NSE market capitalization fell ever so marginally at 10 basis points, which means there was nervousness and a broader based lack of buying conviction. Market-wide position limits, or MWPL, went sharply up, which is routine after expiry. The US headline indices rallied strongly, and that basically provided tailwinds to our market as well. Now, friends, I come to the ratio chart of the Bank Nifty versus the Nifty 50. And the reason why I keep harping about this ratio chart is because the banking and financial sector stocks command a whopping 32.5% weightage in the Nifty 50. You cannot have a broader based rally in the Indian financial markets unless banking stocks are pushed higher. And since the banking space is number one, the combined weightage of number 2, number 3, and number 4 sectors also does not match up to the weightage of the banking and financial sector stocks. That high is the skew or the tilt towards banking. So this is the fourth consecutive week where the Bank Nifty has attempted to, relatively speaking, outperformed the Nifty 50. Now, remember what I have told you in the past in my multiple videos, that I want the Bank Nifty versus the Nifty ratio chart to go up above 2.25 and ideally above 2.40. That would be the ideal most situation for a sustainable upthrust. But hey, that's not happened yet. So let's wait and watch. The fact remains that there's an inverted hammer on this weekly chart of the ratio chart tells me that higher levels were encountering some amount of selling. Now, as I explained to you about the weightage, this graphic more than elaborates what I am trying to tell you. There is always a cause and effect in the market. Nothing happens without a reason. And there you have the reason, the weightage. Friends, I now come to my in-house indicators. I start with market-wide position limits. This is nothing but the extent of exposure utilized by traders as a percentage component of the maximum possible exposure allowed by SEBI, or Securities and Exchange Board of India. What you see on this chart is a routine fall every 4 weeks, which is on expiry, and then a gradual upthrust over the next 3 or 4 weeks. Last week also we saw a post-expiry routine rally, and the MWPL now stands at 34.95. Now this weekly chart spans 20 weeks, which is 5 derivative cycles. At 34.95, it is the lowest gain in MWPL in the post-expiry week as compared to the 5 prior post-expiry derivative weeks in the comparable months. That tells me that conviction levels were definitely somewhat lower. Now, bulls are showing signs of fatigue. I've told you in my previous videos, retail traders are single-handedly doing all the heavy lifting, but their firepower remains somewhat limited compared to institutional players. Now for the index and stock futures turnover, remember this is 3 cumulative derivative series, so it's November, December and Jan. Here again, turnover tends to go up every 4 weeks, which is expiry, because traders square up in the expiring month and initiate fresh positions in the next month. So that results in dual turnover. So post expiry, there's a routine fall, but the fall is not half as sharp as in prior some months. Now remember, this is also a 20-week chart. So intraday participation was there. Now friends, I come to the advanced decline ratio. This is the average of all 5 trading sessions in the week. While the Nifty basically lost 0.64% on a week-on-week basis, the advanced decline ratio also came down sharply. Do remember what I told you last week in my video at 2.85. The level is absolutely unsustainable. And there you have it, more than a 50% fall in the advanced decline ratio. But still, at 1.31, it tells me for every 100 losing stocks, there were 131 gaining stocks. Bulls were still trying hard to revive sentiments. Friends, I now come to the Nifty and Bank Nifty basis. Now, what is basis? It's the premium or discount prevalent in the future as compared to spot. Just like the options premium, the futures premium also erodes over time as expiry approaches. All other things remaining constant, higher basis shows higher risk appetite. So the basis across both the indices was lower. A, it was time decay. B, it was mild amount of caution, and therefore we need to keep a watch on the basis chart. Nothing to worry. This is data that I share on my social media accounts every single day late in the evening. Do connect with me. My contact coordinates come at the fag end of this video and in the pinned comment below. Now, my in-house indicator, the impetus, which you've trusted for 4 years, and what you are seeing is that both the indices have fallen last week, although mildly, with a slight decline in impetus. So there was not much of forceful selling. Now, do volumes need to rise in a falling market, and does the fall need to be forceful? It's there in a previous video. Do make it a point to watch all the videos I'm recommending in the pinned comment below and in the description below this video itself. Friends, I now come to our in-house indicator, the lift, weight, thrust, drag indicator. You've trusted it for almost 3.5 years now. It stood the test of time. Now, with the Nifty falling 0.64% on a week-on-week basis, we knew that the sentiments were nervous, but just how nervous? From minus 0.41, the LWTD has fallen to minus 0.72. It's the lowest that this chart period covers. And it's a multi-quarter low. That means I don't expect very proactive fresh buying support coming in on declines. although short covering could cushion declines. But short covering can slow down the declines and even cause a temporary pullback rally, a dead cat bounce. A short covering cannot trigger a new all-time high. You need fresh buying for new all-time highs. And the LWTD unfortunately seems to be indicating that fresh all-time highs are unlikely in the week ahead. Now, friends, I come to the bond market. For those of you who know me long enough, will immediately recall that I have placed a great emphasis on the bond market because cost of funds is something that I want all my online family members to understand. I hope you familiarize yourself with the work of Dick Stoken. I have recommended his books to you for many, many months now. It's getting too late if you're not familiar with the theory of cost of funds and the impact on other asset classes. Now, the Indian 10-year benchmark bond yield has fallen for the second consecutive week. That tells you that bond prices have gone up marginally. All right. Now, all the students of Dick Stoken would connect immediately as to what it means when bond prices are going up and yields are therefore coming down. What I told you last week, and as a matter of fact, over many, many months, not just last week, I am still keeping the powder dry. I'm in no hurry to deploy money in gilt funds. I'm not exactly buying the 10-year sovereign benchmark bond either. Remember, we've laddered from 2021 October onwards all the way up to 7.5%. We're in a cushy space, kind of ladder at 6.77 or 6.78. Let's keep the powder dry and wait for the right opportunities, which I assure you will come. Friends, the bond market's done. I now come to the bank Nifty, which basically fell less than the Nifty 50 itself. And the daily chart on your screen tells you that the 0.22% decline was triggered by 4 out of 5 days being falling days. And the price is below its month-long moving average, which is sideways. So the short-term outlook is cautious as of now. The potential head and shoulder. Why do I call it potential? Because the red color neckline is not violated yet. So the potential head and shoulder neckline remains in place. So that support area at the neckline is approximately 50,400 levels. Bullishness, on the other hand, will return only after the Bank Nifty rallies past the 52,500 in the spot segment. Let's take a look at the weekly chart, which on your screen tells you that the 25-week moving average, which is a proxy for the 6-month-long holding on cost of an average bull, is acting like a rough and ready support area. And the market is taking support there and bouncing higher, although the bounces are not exactly very confidence inspiring. The small body of the weekly candle with large shadows or wicks in either direction shows a tug of war which ended indecisively for both the bull and bear camps, although there was a tinge of weakness because the Bank Nifty did fall a little. Do remember that the banking and financial sector space has a weightage of 32.5% in the Nifty. So without this sector participating, no sustainable upthrust. Friends, in the week before last, this index was ranked number 7 on the most volatile counters list based on statistical beta rankings I maintain in-house. It rose by 1 notch to number 6. Not very good because challenge level went up due to volatility. Now, last week, I advocated an estimated range between 53,225 on the upside and 50,125 on the downside, which held perfectly well. In the coming week, I estimate a range between 53,125 on the upside and 50,000 on the downside. Friends, in addition to this range, do make it a point to monitor our daily, weekly, and monthly pivot levels, which I update on our free Telegram and WhatsApp channels. The contact coordinates come in the fag end of this video. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 0.64% and fell on 3 out of 5 trading sessions last week. The index also remains below its month-long moving average, which is sloping downwards. The head and shoulder that I have marked with a red line and text and narration below the price candles are self-explanatory. The head and shoulder is activated and established firmly in place. Price is trading below the neckline, and the measuring move target of 23,225 still remains an open possibility. For bullishness to return, the 24,600 level will need to be overcome, at least on a sustained closing basis. And below 23,750, which is coinciding with the previous swing low, bulls will be at a deep disadvantage. And as they say in boxing, you are on the ropes. Let's turn to the weekly chart, and on the screen you can see that this price candle is below its 25-week moving average, which is a proxy for 6-month long holding on cost of a retail trader. The average itself is flatlining with a tinge towards the downside. Early days yet, but it's flatlining for sure. And the medium-term outlook therefore appears nervous relatively compared to the Bank Nifty. Now, since the Bank Nifty is falling mildly, this index is holding on for now. Any weakness in the Bank Nifty, and you could see some amount of accelerated fall in the Nifty itself due to the steep 32.5% weightage of banking and financial sector stocks. Friends, in the week before last, this index was number 20 on the most volatile counters list as per statistical beta rankings. It rose by 4 notches to number 16. That means challenge levels went up significantly last week. Last week, I advocated an estimated range between 24,925 on the upside and 23,700 on the downside, which held perfectly well. In the coming week, I estimate a range between 24,775 on the upside and 23,525 on the downside. Friends, in addition to this range, please also monitor the daily, weekly, and monthly pivots I update on our free Telegram channel. It'll help you laser precise your entries and exits. Friends, I now come to the last bit of statistical analysis, wherein I measure the footprint of the retail trader by their turnover contribution in the 4 segments in the derivative space. On your screen right now is a weekly chart of the turnover contribution, where the index futures turnover contribution fell by 4 basis points, is indicated as a blue line. The stock futures turnover contribution fell by 36 basis points, indicated as a red line. So in the futures segment, which is more capital intensive, more volatile, turnover went down. In the relatively lower risk options segment, it is the lowest risk segment, which is the index option, that saw turnover contribution go up 57 basis points. The stock options, which are relatively more volatile and capital intensive compared to index options, saw a turnover contribution decline of 18 basis points. Net, friends, I would say that risk appetite was down. Not really surprising. This kind of volatility, up one day, down the other, is something that knocks the wind out of an average retail Joe. Now, friends, I come to my own trading strategy for the week ahead. Nothing much to really change here, because it's the same old happening all over again. My strategy, which I told you would remain unchanged, I would still press theta decay trades in the non-linear options segment on interest rate sensitives, banking, NBFCs, EMI dependent sectors, and companies that are very heavily leveraged with debt right up to the neck. I will also continue to focus on public sector units, and specifically speaking, public sector banks, oil marketing companies, defense sector stocks, power distribution, energy and power generation counters. Now, gold and silver are falling exactly like I advocated in this video, and there is a strategy of what you must do in a market where bullion prices are falling. Do kind of make it a point to watch that video. The long-term strategy remains intact. Base metals, on the other hand, are likely to run into rough weather, which is resistance at higher levels, which means a lot of overhead supply might be expected in metal mining companies' stock prices in the week ahead. Oil and gas continue to remain under pressure, and I've been telling you I don't believe in the super cycle theory in the industrial commodities, either base metals or in energy. And there you have it, the slightest bit of challenge, and these prices slide lower. So theta decay is still an evergreen strategy here in oil and gas. I would continue to trade small, like I've mentioned in this video, smaller footprint per trade, but wait for a bigger price swing, so that compensates kind of for the lower alpha that you might have made because of small exposure. And I would continue to maintain tail risk hedges, like I've explained in this video. These hacienda hedges can actually be a lifesaver, and believe me when I tell you that. Friends, if I have any more updates to the trading strategy, as I think I would have, knowing the kind of market that's coming up ahead, I'll be more than happy to share them with you on my Telegram and WhatsApp channels. Also, don't forget to read my Live Mint column. It's India's first and only media column to offer statistical inputs to its readers. Free to read, no charges here. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you become better traders and what else I could record in my future videos to help you master the trading game. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.